Thanks for joining us today on Market Column. Morella Fernandez, John Zechner on the show with us today, chairman and founder of Zechner Associates. He'll take your questions on North American large caps. Here's how to reach us toll free, 1-855-326-6266. You can email your question in as well, marketcall@bnnbloomberg.ca. John, good to see you.
Hey, Morella.
Thanks for coming in. So earnings season, we are still in the middle of. We're getting a lot of Canadian companies reporting now. Are you seeing similar themes in Canada in the Canadian earnings and the American earnings?
To a degree, we are. Canada obviously is the problem. We're more impacted by, the tariffs and the international trade, and certainly the North-South trade. But it's interesting, Morella, with just the reaction to some of the earnings. I think that's a bigger tell for the overall market. Like earnings disappointments are being absolutely punished. And even in some cases, earnings beats, and you're starting to get that in sort of the higher value tech stocks, Palantir the other day, Meta last week, and all of that, it's just not good enough, and they're selling off. So, and to me, that's a bit of an underlying weakness in the overall market. I mean, we've all been saying for a while that valuations are very stretched, and what's going to be the catalyst. I don't know that there's any single catalyst. I mean, you've had a lot of potential ones, but this is sort of, it's multiplying a little bit, and below the surface, I think the market is doing way worse than the averages would tell you. And I think because we were so tied in the U.S., particularly the S&P 500, which everyone looked at, and it's so weighted to a couple of stocks that have not broken down. When you look at, Apple, Alphabet, obviously the Mag 7, below that, it's been pretty ugly. And, I think it's a tell overall. So, do the generals finally fall? Or, how does that go? But to me, that's a warning sign overall that this continued move upward is hitting some resistance.
Okay, so the indications, or what are the indications for you? We don't have a lot of data coming out of the U.S. right now with the shutdown by Washington. So what are you zeroing in on that's telling you that?
Well, I guess, the data that we are getting is continuing to be weak, whether it's ISM data, whether some of the corporate data, ADP the other day and all that. It shows you the employment is not really gaining. It's not deteriorating dramatically, but it's certainly not getting better at this point. And I guess the commentary from, some of the CEOs coming out of the more cyclical companies, you're getting takedowns in sort of some of the transportation companies. The rail's not really hitting some of the delivery companies and others that are good barometers for the overall strength of the economy. And certainly the low-end consumer and the consumer in general, the fast food restaurant chains. I mean, you saw it from Chipotle the other day, and Cava and those kind of ones that were, they're missing the numbers a little bit. So it tells you there's weakness in the consumer, because it's interesting. For the longest time, it was that all that mattered for the consumer was that they were employed, and that was going to keep them positive. Well, I look at the employment numbers; they've sort of deteriorating a little bit. So maybe the wealth effect, what's going, the gains from the stock market can keep the consumer strong for a while, but that seems like the last leg to stand on again. So like I say, you're knocking these pegs out that have kept the thing moving higher. And so that's why, we've got an overall much more cautious view.
Okay, we'll talk a little bit more about this part later, but where are you keeping your money in, and where are you putting new money?
We're taking money out of cyclical sectors, away from the consumer, certainly taking the tech bet down in a large way. We're not out of tech, and there's sort of names in there. We've switched to more software, gotten out of all the semiconductors and we think that are really dramatically tied to AI. Even you see some of the, uranium related companies, electrical companies and all of that. Got on that. Increased our long bond exposure, just because I think that's a nice hedge. If you get some economic weakness, I think the long end of the bond, both Canada and the U.S. should do a little bit better. Taking financials down, I think they're too tied to what's going on economically, and there's some risk there. I'll move toward the infrastructure names in Canada look pretty good. Certainly what was in the budget the other day and what we're seeing on capital spending in the energy sector. And the most interesting thing, Morella, I think, is sort of being in Toronto just to do this show when I was downtown last night, so the buzz people, they're getting a lot more positive than I have seen probably in decades, that maybe this reversal of money out of Canada that we've seen for the longest time is maybe changing a little bit. I mean, the biggest indicator, quietly, was yesterday, was that deal we saw with the old Encana Ovintiv. sort of coming up to buy New Vista, I thought, when have you seen money moving back into Canada in the energy sector in a long time? Maybe that's not a tell, but the mining sector is looking at something similar. So there's a few things there that are more of a positive, I think, for Canada potentially.
All right. Let's leave it there for this block. We will line up some phone calls, some emails for John Zechner of J. Zechner Associates. He's taking your questions today on North American large caps. We're back in a moment. Welcome back. Let's start with an email from Peter. His question for John today is, should I give up on Lululemon? Valid question. Lululemon, a Canadian company that historically has done pretty well, but the competition in the space has been steep, and it feels like they've hit on sort of some of their styles that normally people would grab up, and maybe they haven't been. Is this a company that you think will recover?
Well, I guess, the valuation has certainly become a lot more attractive on that basis, and the branding is very strong for them, so that should continue. So from that point of view, I wouldn't necessarily throw in the towel at this. I mean, I'm the last guy to ask on this. I work out every morning, and I'm going to say I wear the same workout gear until you can't put it together anymore. But it's but from the point of view of what's hot, they're certainly out of. But the branding, I think, is very strong, and the category is strong, and the valuation is much more reasonable. From that point of view, I don't know if I'd throw the stock out at this point.
Okay. Let's go then to our first caller. JC is on the line. He's in North Bay, Ontario. Hi, JC.
Hi, I'd like to ask about MDA. I know you've recommended it in the past. It's really fallen off even after the EcoStar announcement. Do you think it's getting to be really good value here?
Well, it is. It's interesting, and we have talked about it. We sort of lightened up, and I'm recently on that strength earlier this year, but I'm sort of coming back to it now because you're right. The EcoStar contract was lost, obviously, because they sold the spectrum to SpaceX. The latest rumor, and that's the last leg down we've seen in the past year, is that Globalstar, which is another $1 billion plus contract, is also at risk. And that, again, the idea is maybe that, Apple's part of Globalstar as well, is that they will sell that to SpaceX, which sort of cuts MDA out of the equation altogether. Wow. So, losing $2 billion plus contracts is pretty massive for a company of this size and growth. So, that is a risk, and the market seems to be assuming the worst on it right now. I would counter on the other side. I think the space build out and the continuing use. When you look at any of the cellular companies and others, we're all offering now this direct satellite.
Yes.
Exactly, and this is a growth area. And even what come in the budget the other day is sort of more infrastructure spending that will focus Canadian domiciled companies, and MDA space leads in that category. They've got great productivity enhancements, and the ability to assimilate information coming from outer space is rising dramatically as well. I mean, we lost Maxar a couple of years ago, but MDA is sort of filling in some of that gap as well. So I still think there's a lot of growth there, but clearly the short-term risk is that something happens with the Globalstar contract. I don't know that it does, but that seems to be the rumor in the past week, and people are shoot first, ask questions later kind of thing.
Do you think he should buy in a little bit more at this, or just sort of ride it out?
I've been buying in. We were on the buy side of it a little bit this morning. I think I'm already down on that buy, but I tend to leg into it because I think even you assume the worst. On that basis, the company's going to be around. They've still got a pretty good backlog, and they got potential contracts going forward, even though this will be quite a hit to take. Okay.
JC, I hope that helps you out. Let's move on to Michael in Vancouver with a question. Hi, Michael.
Hello, Marella. Hello, John. John, thanks for taking my call. John, my question is on Microsoft. I know it's often talked about on this show. But basically, it's off about 10% from its highs, and it's off another about $10 this morning. I haven't seen anything that basically justifies this, other than the valuation might be a little on the rich side. Do you like it? Do you own it? And can you tell me a little bit more about this? This fall off over the last few weeks.
Yeah. What do you think of the tech fall off at the start of the week?
Well, that's what you and I were talking about earlier, and the big guys haven't really fallen as much. I mean, you look at what Microsoft is down is not that much, and certainly there's a valuation argument that suggests that, yeah, it's a very expensive stock. Having said that, I mean, the Azure growth was, 40% plus for their public cloud in the last quarter, and they continue to deliver. I mean, side story is interesting. I mean, we switched from backroom servers when I had at our company. When it was time to renew them and pay, I think it was like $30,000 or $40,000, I switched to Microsoft Cloud, and it's just unbelievable how suddenly everything is their problem kind of thing. They worry about security, cyber, everything else, data storage, accessibility. So you can see why they're winning all this cloud business, and they'll continue to do it. But it's a competitive market. I don't know what Oracle is going to do as a fourth player in there. They're coming in sort of heads on. And what the AI transformation, how well you can monetize the AI transformation ultimately. I think that's going to be a bigger question for the hyperscalers and for Microsoft in particular. So we don't own it just because there's other things that are cheaper there that I'd rather play, and you can't own everything. And but it's a big one to be missing out on. But there's an overall sector weakness, and there's a little bit worry about the monetization of AI across the board. And these guys are one of the biggest players and one of the biggest winners from it.
Do you worry about it bouncing back? Do you feel like it could bounce back, or do we just not know, given valuations being stretched and how nervous investors are?
Well, investors could get nervous, and what worries me a little bit with the whole market is there's been so much sort of passive investing and other things, and it just reminds me of the late 90s again, where people don't understand what they're buying, and that I think that as much as you can overshoot on the upside, you can overshoot on the downside, and we've seen a couple of examples of it earlier this year in 2022. So, I mean, you can move these things in both directions, and I worry that that move could come quickly and sharply for all of these companies. And people, you've got the highest level of equity exposure ever in the U.S. Over 70% of financial assets are in stocks right now. It's almost unheard of level. Although I keep hearing, there's $7 trillion on the sidelines going to come in. Well, maybe every last single dollar will come in. I don't know that that's necessarily true. So, yeah, the market has some risk, and Microsoft, it would be front and center because of the capitalization issue, obviously.
Okay. Let's get to another caller then. Frida is in Chilliwack, BC. Hi, Frida.
Hi. I'm concerned about Shopify, and it's gone down, but I'm thinking of the Christmas sales and how that will affect Shopify. Thank you for your help.
Thank you for the question. Shopify tends to be a pretty volatile stock.
It really does. And I mean, again, it's valuation stories. We've talked about Microsoft and how high valuation is nothing compared to a Shopify is. On the other hand, look at, the numbers. They're high 20s to 30% annual growth rates. I mean, they get uniquely positioned in the market. They also remind me a little bit of Amazon sort of 8-10 years ago. I think they're getting to the point right now where they're sort of generating better operating profits and operating profit margin. I think you're going to start to see a lot more of the growth flow to the bottom line. I mean, that's a long way to improve the multiple, but I think they've got a unique position, unique product, and they're certainly assimilating sort of the mid to small businesses in terms of, online transformation. So, that's a big market, continue to grow. They own it for now. So I like it. It's a big index weight in Canada, so I don't hold what I call an index weight position. I think that would have to be 6% or something like that out of the portfolio. But we have a decent position in stock. I continue to like it. I see no reason to sell it in here, within that tech frame.
Okay. We're going to take a quick break, lining up more phone calls for John Zechner, Zechner Associates. He's taking your questions today on North American large caps. Back in a moment. Welcome back to Market Call. Robert's on the line in Toronto with a question today. Hi, Robert.
Good afternoon.
Go ahead.
Yes, I'd just like your opinion on Well Health Technologies. Thank you.
Okay, thank you for the question. Well Health sitting at 451, I think, today, down a little on the day. Tell me about Well Health.
Yeah, the numbers just came out, and they were in line. I think the U.S. numbers were a little sloppier than the what they had on the Canadian side. I think they're supposed to start divesting some of the U.S. assets and focus more on Canada. I mean, obviously, they're remote health is a growing industry, and these guys are well positioned. They've done a lot of acquisitions, trading about 10 times operating cash flow. Sometimes I have a hard time with a company like that at the growth stage in healthcare, because there's regulations and other things and competition, so it's hard to get a good grip on. I don't find it particularly. We had bought it earlier this year, and I sold it not that long ago, so it's on our radar screen, but we don't have it in the portfolio right now. I just need to have a closer look at the breakdown of the numbers. I would like to see them divest some of the U.S. assets and get more of a focus in Canada. I think you've got too much on the plate right now.
Okay. Let's move to our next email then from Morris. What is your outlook on Nutrien? And I'm going to add in the federal budget, right? Wants to protect critical minerals. Potash might slide in under that. So what do you think of Nutrien moving forward?
I like Nutrien in here, and I think it's undervalued, relative to historical trading levels. They're dominant in key markets. They've done great vertical integration to the retail operations. It was up today on some rumors around speculation that they're going to sell off the phosphates division, and phosphates are the three of the nitrogen and the potash and phosphate. Phosphates is certainly the smallest, and so if they crystallize something there, use some of the money to pay down more debt, increase stock buybacks, that would be good, because the bigger operations are obviously still potash and nitrogen, and then the way they've, like I say, assimilated that into the real retail operations. I mean, yeah, looking at long-term chart, they had that great spike, obviously, when the Ukrainian Soviet incursion began, and supplies have sort of moderated a little more since that over a period of time. But I think you look at it on a long-term basis, trading at the lower end of the valuation, dominant market share in certainly two key commodities.
Okay. We hope that is good for Morris. Let's move on to another caller. Tony's on the line. He's in Toronto today. Hi, Tony.
Hi there. John, your thoughts on United Health? They had their earnings call last week, and the stock has been down about 15% since then. Any explanation for that, and what are your thoughts mid to long term for United Health? Thanks. Yeah,
we don't own it right now. I mean, certainly Buffett organizers getting involved in it at the lows, was a positive, and some ideas that maybe the PBM market was starting to get a little bit better for them. So the benefits managers are sort of contributing a little bit more. So health insurance in the U.S. is still a difficult market right now. And certainly, the criminal charges potentially brought against them is a huge negative. It's going to impact them multiple over periods of time. My strategy is there's a better play in this sector would be CVS. Because they have the drugstores, but they also have the PBM, the pharmacy benefits management, for a lot of business, similar to United Health, and they'll get a similar pickup. I think if you've passed the worst and the insurance operations started improving, but you're doing it at a much cheaper multiple, whereas United Health is trading sort of in the high teens. You get CVS around 12 times forward earnings.
Yeah. So. 79.21 is where we are for CVS today. So you think that's a better bet? That's
a better bet in the same sector, playing sort of a similar business structure. So.
Okay. Okay, let's move on to Dawson then. Dawson's in Barhead, Alberta. Hi, Dawson.
Hello there. I got a question on West Fraser. Is it a good buying opportunity now, or should I just hold on and wait for a little bit lower here? Thank you. I'll hang up.
Thanks for the question. We will pull up West Fraser.
Yeah, there's a few stocks out there that are really tough calls right now because the current business outlook is just so absolutely miserable. Like I throw, Algoma on the steel side, obviously, for what they're doing on the plate, obviously because of the tariffs. And then the lumber companies as well. They're just, they're basically not making any money at all, and the prognosis is they won't. Having said that, that's when I tend to get a little more interested in companies when they're sort of, you've got the worst case situations out there, and that's being factored into the stock price. So I don't own West Fraser. We did start buying Interfor recently, and what I like about Interfor, again, same story, lumber, but a lot of their lumber is domiciled in the U.S., so they're not as negatively impacted by, obviously, the tariff strategy. But yeah, you need to figure out what's going on with these ridiculous 50% tariffs on, softwood lumber, and what's going on in steel and aluminum and others, because you're just, you're decimating these businesses. And the government's coming in and gave some support to Algoma, and they're going to probably give some to the, the lumber producers as well. But why don't we just settle the trade issues instead, if that's a possibility?
Well, I was going to say, not everybody wants to play ball on that.
Yeah, no kidding.
Time,
yeah,
so we'll see.
Yeah.
Okay, I hope that helps Dawson out. Let's go to Ryan in Saskatoon with a question. Hi, Ryan.
Oh, hi, John. Just had a question for you on GoEasy. Just kind of these subprime lenders as well as Propel Holdings kind of taking a hit the last day or two, I guess. Just wondering if you'd be stepping in here. Thanks.
Yeah, you know what? I don't own GoEasy, but when it took that recent tumble, it sort of gets onto my radar because I always like to look at these companies that have had big run-ups and then they have pullbacks. And, you know, it reminds me a little bit of the structure of Home Capital. I remember, you know, Home Capital, you could have bought at very depressed levels that ultimately got taken out at a pretty superior price. But, you know, what's going on in the subprime mortgage, what the quality of their mortgages is, and there's some questions around that right now. I need a couple of quarters to get a little more comfortable that, you know, what the quality of the portfolio is and, you know, that they're not going to have to take further hits and write-downs and all. So we don't own it right now, but it's certainly having a closer watch on it. And, you know, it's come down a long way, but, you know, sometimes that doesn't mean anything when the stocks run up that much and there's some questions about what the credit quality is. So.
Okay. Let's take a quick break. We are going to go through John's past picks when we come back. Stay tuned. Time now to take a look at past picks from John, December 2nd, 2024. At the time, he chose these. Atkins Realis was the first one. At the time, it was 75.65. It's up to 95.96, a 27% upside and total return of 27%. And they'll likely benefit from the build out of nuclear energy projects, right?
Yeah, and they had already had quite a run up, you know, prior to me picking them last year. So they, you know, it is, as you know, the old SNC, and it's just, yeah, this pivot they've done. It's not only the fact of what they're doing on the nuclear, on the CANDU reactors and all that, and the expertise and the growth they're seeing there, and obviously more, but it's the rolling out of these old long-term fixed price contracts as well, which were a big drag. I mean, the old story used to be is, you know, you say, here's your project, it costs X, and to really get any cost overruns, the engineering company has to eat those. Now they're just sort of doing, you know, basically a service fee, and you charge accordingly. So that's a better business model and gives you higher margins and more stability in the earnings.
Is it one you've held on to?
Yeah, we still own it. We're still there, yeah.
Okay. Let's get to your next past pick, Pfizer on the New York Stock Exchange. 25.82 at the time to 24.65 US right now. So a 5% drop return, under 1% for a total return about 0.5%. Let me ask you about Pfizer and sort of comeback opportunities. We know that whole pharma space in the U.S. was pushed down with all of the questions about what kind of deals are going to get from Donald Trump.
Yeah.
Is this a company you've moved out of, or are you sticking with?
No, we still own it. I mean, having said that, a year ago, I wouldn't have picked it if I had known Robert F. Kennedy was going to be HHS director, you know, Mr. Anti-Vaccines and these vaccine company. But no, and this has been a bit of, you know, you might call this a value trap. It's trading at, you know, 10 times earnings with a 6% dividend, cheap, but people worry about the growth. What I like about Pfizer is they took, you know, we know what they did in the COVID and all the money they made off of the vaccines, and it was absolutely huge. What they've, I think, smartly done is they take that money and they reinvested it into other potential growth areas, you know, mostly in oncology drugs. And they haven't seen the results of that yet. I think they will set a better growth profile going forward. Right now, they're having this battle for Metsera, which they're trying to build, which is sort of, I guess, a third player now in the GLP drugs. But now Novo Nordisk is sort of competing with them for that and coming with it. So that's a bit of a fight, and that's been a recent drag on the stock. But like I say, I looked at it. The earnings came out this week. They were better than expectations. You're looking at $3 in earnings right now. So what's that? An 8 multiple. Got a 6% dividend yield, good balance sheet, and some potential growth from these oncology drugs they've been buying, as well as their existing pipeline. So, you know, I like it. It's not, it's certainly not done too much, certainly in the past year, but it gives you a lot of downside protection in this market and some dividend yield.
Would you pick it up at this point?
Absolutely, yeah.
Okay, good to know. Let's get to your third pick then. Meta Platforms from last December on the NASDAQ, 592.83 US, now to 627.77. So a 6% upside for return and a total return as well. Meta, one of the big Mag 7 that's off the past week with results coming in, which are strong, but at the same time, people are worried about with Meta how much they're spending on AI and whether they're going to see the results of that, and then generally valuations, I guess.
Yeah, no, they've hit hard in this past week. You and I were laughing about this in the break. I would have done better doing this pick a week ago. But yeah, they have become the poster child for the negative reaction, I think, to AI spending and the productivity of that spending. And I think the issue with a lot of investors, the difference in the big four hyperscalers, if you look at it, the other three major players, hyperscalers, all have public clouds. Meta doesn't, but they implement their AI through their existing platforms, whether it's WhatsApp, Instagram, Facebook. Threads, Facebook, whatever. And that's where they're getting the productivity. And that is driving advertisers to those sites. And the advertisers, these are going to be the best and most immediate beneficiaries of rolling out AI, in my view, is because they can demonstrate to advertisers how they can improve their productivity, how they can hit their targets better, how they can hit their customers, and what their customers are buying. And they're doing all of that through the apps. And which is why, I think their revenue numbers are good and their advertising numbers are good. Valuation now, we're talking about stock at 20 times forward earnings. So, I continue to own it. We add a little bit on this. We owned Alphabet as well because that's the other big player on the advertising side. But I think the hyperscalers will be first to monetize AI better than anybody else. And I think that's a positive because somebody has to start monetizing all of this spending. And again, the negative was the increase, and you look at the capitals of the four major hyperscalers, and it's north of $400 billion next year. It's a crazy number to say we can do this without seeing something on the other side.
Okay. Let's leave it there for past picks. John, sticking around, of course, take more of your questions right after this break. Welcome back to Market Call. Let's go to Jack. He's on the line in Toronto. He's got a question today for John. Hi, Jack.
Hi, good afternoon to both of you. John, I'd like to ask you about Celestica. It's tumbling today. It's going up, it's going down. I have lots of it. It's to keep or to sell.
Okay.
And you also own it in your portfolio. Thank you very much and have a nice weekend to both of you.
Thank you very much. Let's have a look at the Celestica line chart. We'll pull that up right now. Is this something you own?
We don't anymore. We did sell it, and we're out of the stock right now. And actually, I left. It was a great run for us. We sort of bought the thing around $50 2 years ago, but I've left probably $100 on the table on this one.
Well,
it's continued to run up. But my issue with it right now is and I think that we're going to hit a point on the build out of the data centers where you're going to be capacity issue. You overbuild capacity. Much of you overbuilt telecom in the 2000 years. And when you do, I think a lot of these stocks are going to come down pretty dramatically. And I think you only have to look to earlier this year when the DeepSeek news came out, a DeepSeek rumor, and suddenly, the cheaper way to do AI, and we're not going to need all the data centers.
Yes.
Celestica was trading near $200 at the time. In a heartbeat, it was down to almost $100. And that's the issue. And Celestica, when we talk about Meta and others, they're good long-term growth stories, so they may have pullbacks and get ahead of themselves on a valuation basis. But, I think you can own it for the long term. Problem I have with Celestica, it's a low-margin business. Like, I've known this company since the mid-'90s, since it was originally, the IBM manufacturing side. It's always been low-margin business. So everything capacity is a bigger issue. I think when you start to slow this stuff down, there could be a lot of air underneath the earnings there, and certainly the valuation. This thing traded at 10 to 12 times earnings for years because there wasn't much growth and it was low margin, and it wasn't really, a sexy end of the tech business. Now it's trading at 40 times earnings, and I think, okay, come on, I think we just need to sort of get your heads on straight on this one a little bit and say this is not going to last forever. It's been a fantastic stock. Take some profits.
Trim it then. Okay, Let's go to another caller. Janet's on the line. She's in Scarborough, Ontario. Hi, Janet.
Hi, thank you for taking my call. My question is on Dollarama. So for several years, it's been going up every year. So we can see it going up every single year, I believe like 5 to 10%. Do you see this trend continuing? And where do you see it going from here, let's say in about 5 years' time? Thank you so much.
Thank you for the question. Would you put Dollarama in a sort of staples sector and with the consumer sort of stretched the way they are?
Yeah, that's funny. You're right. Between consumer staples, consumer discretionary, it almost sort of
blends into both.
It really does.
Yeah.
It really does. But is there growth that's really been fantastic? Same-store sales growth has been good. Obviously, expansion of the stores within Canada, and now they're doing international. They did it in Mexico as well.
Australia.
So, yeah. No, they're continuing on. So they've got a strategy that works, and they're rolling it out. There's going to be more competition, and obviously the valuation is high. Which always is difficult for me. I'm not, one to buy, high-valued stocks like that where the growth rates, not justifying it. But then on the other hand, I compare it to a Costco or something that's trading north of 50 times earnings. It's not necessarily that bad. So as a growth stock, it probably continues to grow. I don't think you'll necessarily see the same performance you've seen over the past number of years. But their product categories continue to expand. They take the price points higher. The margins have held up. The one thing I did worry about with all the tariffs and everything for a while is that going to impact do they source goods internationally?
Where do they come from? Yes.
And I haven't seen really impacts over the past quarter. I haven't seen it yet, but it'd be something worth paying attention to because in a lower margin business, that would be a risk.
Yeah, I always remember Dollarama, dollar stores, everything was $1 until they weren't anymore. Now
exactly,
they're $4 or $5 when you go in there. Okay, let's move on to Amin in Ottawa with a question. Hi, Amin.
Hi, good afternoon. My question for the guest is about MEG Energy and Cenovus. I voted against MEG Energy takeover, and I also own CVE. So shall I buy more CVE? I have money for that, and I'm doing very good on CVE. Thank you, and have a nice day.
Well, it's a done deal now. So, you own Cenovus going forward, basically, because they're with 86%, I think, voted in favor or whatever today. So it's going to be happening. There's nothing else to discover there. So you have to say, do you want to own Cenovus? I think, well, quite honestly, I would rather own a stock right now if I get in an energy stock that has a little bit more natural gas exposure, because I think there's better growth there going forward. Cenovus does, and Cenovus has cleaned up their sort of refining operations a little bit more. It was a real drag for a number of years. They've improved that. And, the MEG assets are going to be a great fit for them, obviously. So, they're a good levered play on oil, but there are other better levered plays on oil. But I'd be more inclined to get a company that has more natural gas exposure. I mean, ARC Resources would stick out to me or is a better name to own right now in the sector if I was putting new money in.
Okay. And you're expecting, a lot of people are expecting natural gas to boost, but prices have been pushed down for a while, so it's going to take a year or two before that picks up, I imagine.
Oh, yeah, especially on the Canadian side, too. And you're right. You get the weather-dependent end of things as being an issue. But I think Canada, if we're looking at this more this east-west strategy, that what they need to do on a global international basis to offset what's going on with the relations with the U.S., we have to sort of move towards LNG and terminals and all of that and make that a better ability to export, because especially when you look at how dependent Europe is on natural gas from Russia, which, obviously you don't know how long that goes on for. So, I think there's a market there for us, for Canadian gas, but you have to have deliverability, you need pipelines. It's a long-term story, and you're right. There's going to be ups and downs related to weather and other things that doesn't say that you're going to get the results today, but I think it's a better growth commodity than oil.
Okay. We're going to take a quick break. More of your phone calls and your emails when we come back. Stay tuned. Welcome back. We are going right now to read an email from Bev. She says, please comment on Whitecap Resources. We'll turn that question over to John. Tell me about Whitecap. We were talking a little bit about the energy space a short time ago. Do you like Whitecap? Yeah,
I do, actually. And it's funny, that last caller in Cenovus, if I were to take an oil-levered name, I'd be more likely to get Whitecap right now. First of all, I think they did a steal on the old Crescent Point. What was it called? Barron, when they finally took it all. The asset they got there, were prime, what they've got, obviously, in the Montney and Duvernay. And, good management team, a lot of light oil in there, and it's a good growth profile and, decent valuation, too. So, like I say, I'm more inclined to move towards the natural gas players, and Whitecap isn't. But if, on the light oil side, and oil generally is a mid-sized producer, I think they're great, and I think they haven't, really fully realize yet their benefits from that Varen takeover.
Are you concerned at all about the price of oil, and if there's going to be a bounce back with OPEC doing what it's doing and everybody else focusing on different kinds of energy?
Yeah, I still have concerns. Like I thought it would actually break below the $60 level and go down further. It's held in relatively well, but when you look at if some of these excess production starts to come back on, and there's a few other things. With so many geopolitical risks, but you got to shake your head a little. What's the U.S. doing with Venezuela? And if they actually did something more aggressive there and you had a regime change, the first thing you'd see is Venezuelan oil production coming back on the market in a hurry to a higher level. So, there's a lot of balls in the air there, and yet demand isn't necessarily growing. There's still some excess supply. So the oil market still looks a little tough short term, but, maybe the stocks are fully reflecting that. So, we are picking away at some of the names, and Whitecap sticks out as one that, looks like good value here.
Okay. Let's move on to caller Chad in Saskatoon with a question. Hi, Chad. Chad, are you there?
Good afternoon, Marella and
Hi.
John.
Go ahead.
My question for John is on Amazon. Obviously, it's had a good run up to this point. Do you see any more upside to it, and would you buy at this point? Thank you.
Thank you for the question. Amazon, of course, doing its AWS, which has done pretty well in its latest quarter. Is this a company you think has more growth on that side of things?
Yeah, absolutely. And we, of the Mag 7, the three we still have in the portfolio are Amazon, Alphabet, and then Meta. We were added to a little again recently. And I continue to like them. I think these guys will monetize AI better than anybody. As you say, AWS, you've gotten back onto a 20+% growth in the past quarter after they had, I think, stumbled for a few quarters. And some people were worried they were losing competitive advantage there, and they didn't have enough of an AI association within the product in order to get more sort of business usage out of it. I think they're sort of putting that worry away. What's really interesting though, Morella, people don't talk about it that much, and this is as much Netflix as Amazon. When you start to talk about the media companies like Disney and all of that, studios are becoming massive. Like, you start watching Prime or something like that, and all these productions out of Amazon Studios and all of that, they're generating such big cash flows, they can put that back in. So it's an additional asset that these guys have. You look at the Netflix valuation, I thought, well,
Netflix is off the chart.
Yeah, and you're getting that buried. You're getting that for free almost in Amazon, and nobody ever talks about it. You talk about, Amazon on the, obviously, the
retail side.
The retail side, and then AWS, but they got this other asset as well, which I think they're doing fairly well on. So.
Okay, I think people just look at Netflix and it's such a big player and so hard to compete with at this point that they look at the other players and think they're never going to get there. They're never going to take a bigger part of that market.
And I think, streaming in general is such a growth industry. Like, how many services? I got all the services basically, and so you sort of drop them off at a time. It may change on the programming, but it's not a one winner take all kind of thing. There can be a lot of winners in that, and they've taken it away from traditional cable, who is the absolute loser in this. So.
Okay, let's get to an email then from Angela. Is Angela on the phone or is she an email? Okay, let's get to Carol. Carol's email says, your thoughts on Aecon, please. Aecon, construction sort of engineering company, they'll benefit from a build-out in Canada.
They really will. I mean, they've always been front and center more in Ontario and construction and all of that, and they continue to benefit from that. But in the last year, they've done very well. They've bring out the margin on some of their existing contracts. Again, it was more a problem. Aecon had what we were talking about earlier with SNC, the old engineering companies used to do these long-term fixed price turnkey projects. Where they really end up taking baths on because the cost overruns and everything would have to be eaten by the engineering company. I think these engineering companies are starting to figure out the game a little bit better and more doing, a fee-for-service kind of business, and that takes the volatility out of the earnings, maybe give them a higher multiple and become a better story. At the same time, where infrastructure spending, as we know, is increasing dramatically in Canada and, Ontario in particular. So.
Okay, so that's good for Aecon. It's at $29.52 today. And now we'll go to that email from Angela. Hi, John. She says, could you please tell me why Thomson Reuters is falling? Thomson Reuters, a media company, but also does, I guess, legal data as well?
Yeah. No, they've got a couple of verticals that are all of that, that they're very dominant. And I think the issue is just the valuation. I think people realize for the level of growth you're getting from this company over a number of years, which is good. you got a 25 times cash flow multiple, and that's pretty excessive. So, I think once in a while the market just starts to choke on valuations if you can't demonstrate anything new or anything new in the growth profile. You're right. They're very strong in the legal. They're obviously very strong on the, the financial verticals as well, although they did sell out of their the old Reuters that they had bought, which was a big acquisition for them. So, and I just think there's less there, and the valuation is more of an issue. And I think that's why the stocks come under some pressure, because we've seen that across the board lately. Outside of the Mag 7, you've seen a real deterioration of some of the these tech companies. So.
Okay, so that's playing out on Reuters as well. That's all the time we have for your phone calls and your emails. But John has new top picks to share. That's coming up. Join us tomorrow on Market Call. Christine Poole will be on the show. She's Co-Chief Investment Officer at Davis Ray. She'll take your questions on North American large caps. And if you missed Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for John to share some new top picks. I'm going to start with a gold stock, Torex Gold, TXG on the TSX. Why Torex in the space?
Well, I guess the valuation, it's trading at a discount to net asset value, about 5 times operating cash flow. And even though it's had a great move in the past year, but what I like about these guys is they had a discount valuation because their big El Morales property in Mexico, their El Limon mine, was sort of hitting the end of its useful life. And I guess why people were worried about it. But in the past year, they've moved to a different mine on the same property, the Media Luna, and they've brought it into full production now without missing a step. So around over 400,000 ounces of production, they're generating free cash flow. And at the same time, they went underground at Media Luna as well as the old El Limon, and they've found underground periphery as well, which includes about 30% copper. So it's I love it from that point of view. They've done a fantastic job. It's underappreciated. It's a discount multiple, and I just like the gold general still, Morella. I just think it had this big run up, I think, from 3,000 to 4,000. I think maybe the public started chasing a little, got aggressive, but I think, and so it pulled back from that 4,400 level. But you look at central banks. Central banks are long-term buyers. They're not stepping away from this market. They will continue to add, to diversify their reserves, get away from the U.S. dollar and fiat currencies in general. I think gold benefits, and the gold stocks are cheap at this level. I think gold could still go higher. Interesting.
Okay, gold, spot gold today at 39.87, so under 4,000. But you think there's some comeback here?
Yeah, and I think they're cheap regardless. Torex certainly is at those levels.
Okay, let's get to your next pick, which is Cargojet. CJT on the TSX. Cargojet runs across Canada. I don't think they're affected by tariffs. Right? They don't go south of the border?
They don't do as much north-south. They do a lot of overseas. They got the DHL agreements. No, you and I were a little laughing about this earlier because this one just came up yesterday when I was looking for top picks, and they just got decimated on the recent numbers. And then the street does what the analysts do. They take the numbers down a little, and then everybody takes the multiple down at the same time. So you get that double whammy on the stock on the downside. The same way when things are going well, they get that double whammy on the upside. And I think that's creating a great buying opportunity. This stock has typically traded, between 8 and 15 times operating cash flow. Right now, they're at 6 times forward operating cash flow. They got great long-term contracts, and particularly with DHL. They reduced their capex, so they're not going to increase, the amount of space they have if you haven't got the demand right now. Clearly, the risk is demand in the short term because of the trade issues and everything else. But they're east-west, a lot into China. What hurt in the short term was actually some movements in Asia, some of the north-south movements as well there, that it sort of hurt some of the current quarter and maybe for the next quarter or so. But it's, I think it's cheap and it's worth a shot, and the stock's totally, it already reflected the bad news. That's what I like to buy these things when they're sort of beaten up already. And, you may not catch the bottom, but you're mitigating your downside risk.
And tariffs aren't a concern because it has affected, I think, international shipping generally, right? Yeah. Not just north-south, but I'm sure less is coming in from China as well, since Donald Trump has China in its sights as he does everything.
Yeah, I think there has to be some belief that what's happening with global trade is ultimately going to get sort of settled to some degree. I mean, globalization is what drove this economy for 4 decades effectively and benefited for everyone. Just because the guy in the White House wants to turn off that, for his own reasons, wants to turn that off for a period of time, I don't think that's going to stick necessarily. In the end, globalization is a positive for all involved, and I think you'll see, you will return to some sort of semblance of that, and it'll benefit these, obviously these transport companies.
Okay, let's get to your third pick then, which is Adobe, ADBE, on the NASDAQ. There have been a lot of questions about whether this kind of company will get, eaten up by AI, if AI can progress to the level that Adobe's products offer to customers. Why do you like Adobe?
Well, to quote famous author, the rumors of the death of application software are premature, I think. I think that's been the problem with all, whether it's Salesforce, Constellation Software, all these guys have come under pressure because the idea is AI is going to sort of remove the need to have these software embedded systems, and customers will not pay for them. I was on a conference call with Adobe recently. I mean, stock is trading at 16 times forward earnings right now. So I think you've put some of the worst in there. And the Adobe, the PDS, all of their basic programs are going to continue to be used. In fact, you can implement AI to a large degree on that and sort of bring that into the enterprise system, and you can bring your business customers to use that more effectively. So, like I say, I think people are making assumptions that companies aren't going to rip out all the software they've put in place for decades and spent millions of dollars on, because AI can offer an alternative. Maybe over time they're going to migrate some of that or change the productivity of it. But in the short term, I think the stock market, they typically tend to do, they worry too much too quickly, and I think that creates opportunities, and I think this is one of them.
Okay, and Adobe, are their subscription offerings reasonable enough for their customers to not switch?
Well, I guess, pricing might be an issue. Pricing is what might come under pressure over time, but usage will be the other. Can they get them to use more and implement more? You have to demonstrate to the client that, this is going to improve the productivity. It's worthwhile, exactly.
Okay, so we'll see if Adobe finds a way to do that.
Yeah.
Okay, that does it for the show. John, thanks very much for coming in.
Marilla.
Good to see you. And thank you very much for joining us today on Market Call. We'll see you back here again tomorrow.